Exercise 9.8 is a continuation of 9.7, but with a twist. In 9.7, remember the 9% bonds were sold in a 9% market. Well, now they're saying no, the market is now 10%. So the market is 10%. We're still paying 9%. So our bonds will sell for a discount. They will sell for less than face value. They will sell, and they give us the number, $457,102. You can double check to make sure, but that's exactly the right price. Now, we're still going to be paying 9%. So our cash out is still going to be $22,500. But it should be a different number. It should be more than that because the market rate is 10%. So on January 1st, we issued the bonds. So this is our carrying value on the date of issue. Okay, that's when we sold the bonds. So instead of getting $500,000, we got $457,000. Now, on June 30th and December 31st and every year from then on, we're going to be paying $22,500 per year. But that really isn't the right amount. Think about how you pay interest. You pay the interest rate based on the rate times what you owe. So we owe half of the market rate, 5%, times $457,102. That's how much we should be paying. And if you work that number out, if you do the math, it comes out to $22,855. The difference between those is the amount that is amortized. That's the increase in the carrying value. That will build this number eventually to the $500,000. So we have $355. That's the amount of amortization of the discount. That gets added to that number, and that brings that number to 457. 457. Kind of a neat number in a weird, gee, I really like numbers sort of way. Now, the next time around, we should be paying 5% still times 457. And when you do that number, you come up to $22,873. The difference between the cash that we paid and the amount of interest we should have paid is the amortizable amount, and that works to $373. And that gets added to our carrying value, and that brings that to $457,830. And if you were to carry this all the way to the end, at the very end, after the last interest payment and the last piece of amortization, this amount would be $500,000. That's the whole concept. As you amortize the discount, you're adding a little bit to the interest expense, and that increases the carrying value. You're going to see that a premium works exactly the same way, but in the other direction.